All right, well, thanks everybody so much for being here on this Saturday. So we're going to get into what I kind of put together called the Smart Sellers Playbook. So this is going to be kind of dedicated. We're going to go through some really cool option selling strategies that have also built-in protection. So kind of a 7-step plan I put together. So we'll go through that. And we'll have a Q&A. Want to make it as interactive as possible. So if you've got a question, please let me know. Hold on one second. Yeah, so let me just 1 second here. So yeah, as a member, David, you will have a part of your membership, you get a 60% discount. You'll get a member's code that will give you 60% off of anything on the website. All right. So any courses or software, just anything. I'll just show you real quick and then we'll get going because I know there's a lot of things we need to cover here, but just a quick one to answer your question. If you want anything, once you're a member, just go to the website powercycletrading.com and then you can go to courses here, or you can go over here to trading software. Now, if you highlight over courses, you'll have a drop down that says trading courses. And then all my courses are pretty much option based. So just go through and anything that you see that you want, you can just, look for more details and then a buy, will be prompted and you'll see the retail price on the site. Like this, for example, is $397. If you just put in your members code, once you get it, once your membership, you'll have it put in there, it'll knock that down to 60% off. So you can do that, then just all of my different courses, plus then, any of my trading software. So I've got a lot of great trading indicators and scanners. So just go through there and check it out. So just put your members code in and that'll knock you down 60% off. So yeah, thanks for asking that question. And if you have any other questions, please let us know. So let's kind of dive in. So, we're going to cover today some really nice option selling kind of strategies for, profits, hedging, et cetera. So glad you're here. And, I love these Saturday workshops. Markets are closed. We don't have noise about having to stare at the screen all day, wondered about positions and things like that. So we can just kind of kick back, relax, and talk the market. So today we're going to talk some option selling strategies and some directional. We're going to go through kind of where I think or see the market going here next, and just cover a lot of stuff. And just please, also any questions, fire away. Now, if I miss your question, the GoToWebinar, the questions kind of they scroll down, so sometimes they scroll off and I can't see it. So just put it right back in there again. So little background on my trading journey. I started back in the 80s. I was fortunate enough. Got out of college and was really kind of looking for something that could make some good money or pay the bills, et cetera. And so I was able to get in my foot in the door with a company called Coastal Corporation. They were out of Houston. They were a big integrated oil company with refining, around the world, pipelines, oil, all kinds of stuff. It was a pretty big dynamic company that was rooted and started in Texas by a guy called Oscar White, who was a really famous kind of oil tycoon type guy. So it was a pretty interesting place. So I was able to get my foot in the door, and they actually had a training program back then to, train you on, trading crude oil. It could be foreign cargoes, domestic crude, foreign products, fuel oil, gasoline, et cetera. So they, started me out there, sent me down. They had a big refinery in Corpus, Texas. So sent me down there for about 3 months, I believe, and just spent the whole time just at the refinery learning about how they would bring in the oils from the big tankers out there in the Gulf. They'd bring them in, they'd do what they called lightering. Sometimes they had big VLCC, so they put smaller ships in to bring in the cargo, and then process it, put it through the distillation units. Kind of learned all that kind of stuff. Just gave you a really good foundation. And so spent about 5 years at Coastal, and then they sent me right out. Basically, about 1 year after I'd been in, they sent me to Singapore for 2 years, which was fantastic, and spent a couple years there trading products out there and Asian crudes, and then got a job at a fantastic company. At that time, it was Trans World Oil, which was largest oil trading company in the world. It was Transworld and Fibro, and then Mark Rich. We were the three largest companies. So really interesting company, and their corporate headquarters were in Bermuda. Spent about 17 years with Transworld. They shipped me out then to did a vacation relief for this guy. And one summer after I'd been there about a year, they asked me to stay. That was in Bermuda. I was like, wow, this place. When I walked in, when I flew into Bermuda, I could not even believe how beautiful this place was. You know, I grew up in Texas, and the only thing we had was the Gulf Coast, which is you know, where we were was muddy water, but man, it was just unbelievably beautiful. So they asked me to stay, spent 16 years there, ended up running the trading desk for about 10 out of Bermuda. So this was kind of circa 88. So that was me on the right, and that's me on the left, obviously. So, you know, started my trading journey there because we started trading options back in about 1987, selling, you know, options on crude oil, cargoes of Brent, things like that. So, you know, it was a great experience. We pretty much traded every sector of the energy markets, and then got into foreign exchange, all the futures markets, all that. So very big established, you know, journey there, background, learned a heck of a lot, and continue to learn something each and every day. So that is where we are. And if you don't have sound, hold on. No sound, go out, come back in. Let me put that up. No sound. Go out, come back in. Okay, so hopefully you'll get back in there. So that kind of a little background on myself, and let's get rolling. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, you know, trading, if you think about it, it's a business of probabilities. And to be a successful trader or investor, it really comes down to controlling your risk. And that's what's going to win the game for you in the long run to keep you in the game. So by knowing and better than understanding how to manage and control your risk, it's going to really make a huge, dramatic, and positive difference in your trading or your investing performance. So, you know, to me, the best way to achieve this kind of goal is through the use of options and option spreads. So, you know, once you understand the options, how they work, there are just so many different things that have so much flexibility to add to your trading once you start incorporating the options. So now, you know, they're great because of their basically the pricing structure of an option. So it has the capabilities that the option spreads can offer you a really controlled risk where you really can control the probabilities better. You can reduce your risk. You can increase your, you know, your capital, your return on capital by reducing your risk. And so that's one thing that, you know, at Power Cycle Trading, I really try to look at that, always look at the risk first. And then any of the trades that we're setting up, you'll notice that they're very low risk type option trades where we get, you know, I look at that risk first, and then if we you know, we're hitting singles and doubles, and then occasionally you hit that home run. But we're going to keep our risk low, and that's the key to keeping in the game and you know, having consistent returns. Now, when you use option spreads, primarily is what we do. They're going to provide you that really defined trading risk. This is going to really help you to lower your capital that you're putting up at risk. They're going to give you really great returns because they're going to leverage your returns. But remember, the risk is super low. So don't be you know, people say, well, you're so leveraged, you know, that's dangerous. But it's not when you do use options the way we use option spreads. So we're having our risk super low, which gives us great leverage, which gives us a big return on capital. And options are unmatched for hedging. So they were originally developed for hedging, and a lot of people forget that, and they just speculate, you know, with options without considering the hedging component. Now let's go through a couple of steps here. So step one to understanding, you know, how to trade options is to understand how option pricing works. So to maximize your option profits, you really need to understand pricing of option. So when we're trading options, the most important option factor comes down to understanding the concept of time and also then volatility. These are the two main option pricing components, okay? Now, when we look at time, time is what we call time value, or it's the extrinsic value of your option. So it's the premium a rational investor or trader is going to be willing to pay over the current exercise value, which is the intrinsic value, based on the potential that the option is going to increase in value before it expires. Now, the change in this value of your option based on time decay, we can measure that change using theoretically a Greek we call theta. All right, so time decay, is basically going to always work against the buyers of options, but it's going to benefit the sellers. So the reason for that is what we call, a positive or negative option characteristic of your option. So, for example, if you're long, let's say you go out, you're going long calls, or you're going long puts just to speculate for markets going up or down, they're going to give you a negative theta value. So, what that does is if you're not right on your direction and it just stalls out, that is losing value. There's that theta decay starting to go against you. So that's a negative theta value. All right, now on the other side of the coin though, if you're short that call or short that put, that has a positive theta value. So that indicates that the position is going to actually gain value, even if it's going nowhere as expiration draws near. So that's something that we want to always be aware of trading options, and we want to try to take advantage of it as much as we can. Now, the next really important component for option pricing is the volatility component. So this is what we call the implied volatility. So it's theoretical. The implied volatility is expressed as a percentage of your stock or your securities price. And basically, we're looking for indicating a 1 standard deviation move over the duration. So if we're looking, that's where we're going to look at to the implied volatility and look for kind of that normalized move to start with, which is 1 standard deviation. So we can measure that. So in theory, when we go and we look at, securities movement, within a 1 standard deviation, they should end up within this 1 standard deviation movement of originally about 68.2% of the time. All right, so that's kind of a theoretical probability. And we're going to use the implied volatility of your security then to help us forecast a security's price range. And that's going to be used then to help us select our price targets and then put together a trade and a trade setup. So this is a really important thing to understand, is implied volatility, and then how we can use it to forecast price targets up or down based on standard deviation. Now, when we look then to the value of the option, it comes down to these pricing components. It comes down to your time value component. If I get my pointer up here, 1 second here. Bear with me. This thing is. So it comes down to time value times the implied volatility times your intrinsic value. And once you know then these variables, you're going to be ready to price out the option, know what the premium should be, and then know your setup. Now, your different option platforms or different platforms that people are using, the option models are basically based on what we call the Black-Scholes model. So that's going to be, these components are inputted in there, and then it automatically spits out these type of relative values for your trade. So that's basically how it works. Now, if we go through this, let me see if I can get my drawing tool up here. Here we go. I don't know what the problem is. All right, there we go. So, when we look at the value of the option, then it comes down to these components. Now, there's another, component we call it rho, but that's your interest-free rate. But the main ones are going to be the time value component times the implied volatility times the intrinsic value, and that's going to give us the value of the option or the option premium. Now, let me rearrange this a little bit better here. So my drawing tool's working here. So just to kind of highlight this, how this works, we're going to leave the intrinsic value at a constant of 1. So then we can see, or you can see how the time value of implied volatility affect option price premium. So most every option now is going to have a weekly options, and some even have daily options, some of the ETFs, et cetera. But when you get into Thursday, you're going to have a new option series, and at that specific time, there's 100% time value in that option, as it starts out, on Thursday. Now, here I plugged in a number, implied volatility of 300. And so you can see then the implied volatility then left the intrinsic value at constant at 1, so that gives you your option value of $300. Now, if you come back in over, the weekend or even a holiday, you come back in Monday, you're still getting time decay even on the weekends when the markets are closed and even on holidays. So you come back in after the weekend, you can see here your time value component now is cut in half. So even if the implied volatility in this example, I plugged in 800, it spiked up to 800, you can see that the value of that option is only $400. Now, let's say, the implied volatility is only 200. So then you can see your value of the option would be only $100. So you can really see then how that affects. And at the end of the day, when that option series is, expires on a Friday, the following Friday, time goes to 0. And volatility go to 0. So those are two pricing components that we can then definitely take advantage of when selling options, right? We're keeping that premium, and at the end of the day, it goes to 0. We keep the full premium. So if we had sold it and we'd gotten a premium of $300 at the end of that Friday, if the market hadn't moved against us, into our strike price, we would keep that $300. So that's kind of basically how it works. So it's key to understand then, but the value and how those things are basically determined. Now, the next thing, step 2, is a secret to income, and that's, knowing and understanding how you sell time. Now, we can then actually sell time to take advantage of option time decay or that theta. So the other thing to think about is an option is kind of like a coupon that you get at a store. So, you go to the grocery store, you're always getting these coupons. And a lot of times you'll see it has to be used by a certain date or it's no longer valid. So that's exactly how an option is. You're going to have all these different option series, and then at the end of the day, when that option rolls off, they're no longer valid, So think of it as a coupon, So then you have that option theta, and that also, it's not going to remain stagnant. So it actually is going to increase as expiration draws near it. So it really starts to accelerate. And it also decreases as you go more in the money. So you're going to have less what we call intrinsic value or more out of the money. Okay, so that's going to make a difference as far as the time decay component. So basically the big effects of your option theta really starts to soar, when you get to that 30-day period towards expiration. That's when it really accelerates, and so that's where you get that really fall off in your time decay. So this is a good graph to kind of illustrate that. So you start out here, let's say you go 120 to 90 days out, you're going to have very small time decay or theta. You can barely see it, but then you can see how this really starts to tail off when you get about 30 days out. It really then starts to accelerate. And then we have these weekly options, and those are really turbo time decay, and at the end of the day, when it goes to your expiration day 0, your time goes to 0, implied volatility goes to 0, and that option is worthless. So that's how that really can accelerate, and how you can kind of picture how, the option affects the value of your option is affected by that time and volatility component. Now, step 3 is another really important part, and that's trading the probabilities. And this is kind of what I call the market maker secrets, kind of what they don't want you to understand about options. And it all comes down to your option pricing model, which, inputs that implied volatility, then we have standard deviation, option delta. So it's kind of what they don't want you to understand. The option market makers, the professional money, that's where they're going to really kind of fall back on the selling options for a couple different reasons that we'll talk about. Now, one thing to understand though is when trading broad markets, you'll tend to have cycles, so everything you trade has a rhythm or cycle to it. And what I found is most securities all have a little bit different, what I call rhythm or cycle, the way they trade. So that's one thing. If you trade, certain specific things, you kind of understand how they move and their cycles. But Typically you'll have cycles that last on a swing trade, a daily kind of term basis. They'll last 1 to 3 weeks. Okay, so you'll have a movement. Maybe it goes up 1 week, then it stalls out, starts coming back, or it could go up, maybe for 3 weeks or something, but then it stalls out. So they're never going to go straight up, straight down. So these cycles, you'll have this really good cycle up, and then what tends to happen is that the markets will kind of lose energy, and then you'll have the markets kind of go sideways. Okay, so then they'll trade in these sideways channels about 78% of the time. So based on this sideways price movement, if you're looking at out of the money option, buyers that are buying out of the money for speculation, they're going to end up losing, about 70% of the time, 68.2%, 70% of the time. Now, the market makers, professional money, they know these statistics, and so they're going to tend to trade from the sell side. They're making the market a lot of times. So these option, buyers are really speculating. They're buying way out of the money calls, thinking the market's going to keep going up. The market makers are sitting back, knowing these probabilities, so they're just feeding them all day long. So that's kind of, the market maker secret, the professional money, and it's all based on the math of probabilities. So let's kind of take a look at that. Now, when you look at the option markets use mathematical market probability statistics. The Black-Scholes model is primarily what's going to be used, and that's used for price the movement of your option to its expiration. So by knowing the probability, the kind of theoretical probability of your underlying security finishing within a certain range at expiration, this becomes key, kind of one of the first things to then determining okay, what options to buy or sell, and then what option strategy to use. Now, these statistics then forecast how likely it is that an option will fall within a certain option series price range up or down by its expiration. And this forecast is a theoretical forecast, is what we refer to as the implied move, or you might hear it called the expected implied move of your stock or security. So this implied move, what it's doing is it's giving us this theoretical forecast of a plus or minus 1 standard deviation move of the underlying security to its expiration. So this is kind of the first place we start for finding out, okay, a normalized move up or down, and then this will give us an idea of how to set up different trades with our options. All right, so first thing to understand then are the kind of the probabilities of this and how they're kind of, backed into. Now, for example, if we were to sell an out of the money option, 1 standard deviation out of the money, you're basically starting out with an 84% theoretical chance of winning, or probability of winning. And the way that is calculated is based on what we call the option delta. Now here, this is a normal distribution curve, okay, bell curve of data. So in this example, it's of price data. So for example, if we had the stock XYZ, it was trading at $500 at the money, what we're looking for, we want to forecast, the first thing we want to do is we want to get a theoretical idea of 1 standard deviation move up or down. So in this example, if we had an expected move of say 4%, plus or minus 4%, and whatever the series is, it could be 10 days, it could be 7 days, 6 days, whatever, but let's say it's 10 days is the time duration, is trading at the money at 500, and we have an implied volatility of this giving us plus or minus 20% up or down, then you can see your potential upside would be to 520. So that's going to be your 1 standard deviation up or down to 480. Okay, so this is going to be your normalized 1 standard deviation range of that security based on the implied expected move, which we'll go through. Now that's what we want to know first, to know, okay, what's a normal move up? I call that a normal move up. Okay, so normal move, it could go to 520 over this 10-day period, or it could go down to 480, all right, over that period, okay, or bounce around in between. But those are kind of the statistics. Now, one quick, easy way to understand that is when we look at option delta. Now, a delta of 1 plus 1 or minus 1 equates to like 100 shares. A delta of 1 equates to like 100 shares. So remember, one option contract is equivalent to 100 shares. So, if you have an option price on your option screen, it says 54 cents, that is times 100, that's like 100 shares, that's $54, right? Okay, so we take that, we have a delta of 1, which is equivalent to 100 shares. And then if we had the delta of 16, then you see the reciprocal of that is 84. So if you were to sell this outside point right here at that 520, that's roughly a 16 delta, 15.9% probability there. That's equates to like a 16 delta. So when I'm looking at my option chains and I see a range of around 16 to 20, to me that's that one standard deviation price range, either up or down. All right, so that's how that is determined. So then if you look at that number, okay, so 100 less 16, then you've got an 84% theoretical probability that price will close below 520 by expiration, if it's 10 days, 30, whatever it might be. Or if you're looking at selling that put, it'll close above 480, okay? So that's one way that you can kind of theoretically or kind of get an idea of what that means, all right? So that would be your one standard deviation range. And then your two standard deviations is, about plus 3 or 4, delta. So there's your standard deviation 1, and then here's like going down to 2 right in here, okay? So those are, kind of how you can visually understand, probabilities. Now, again, like I said, the normal range was between 520 and 480, but then if you're going way out here, say to 540 or higher, the chances get less and less. The probabilities are lower and lower that price will be there at expiration, either up or down. All right, so again, these are things that we want to use to theoretically measure probabilities of the trade we're looking at setting up. And here's a quick and easy way that we can do this. And this is using our platform and put up, you can put up your delta, and here's probability out of the money. Okay, so this is a really cool thing you can do with Thinkorswim. So in this example, Apple's trading at 190, and you can see the 190 strike right here has a delta of 0.52. So basically, we're 50, call that 50. So there's a 50% chance price will be at 190 or below, or 50% chance at 190 or above. Now, as you go further and further out of the money, let's say you go way out here to the 215 strike, and you look over here at that option delta, it says 0.05, and then you look here, this is called probability out of the money, that says 95, right? So then that's here's your option delta of 100. You've got that delta, that 215 strike has a delta of 5. So then the probability out of the money is 95. So the way you can read this is that, okay, if you were to sell or buy that 215, if you bought that 215, there's a 95% probability that prices actually will be below that at expiration. Or the other way you can look at it is, there's a 5% chance that price will be at 215 at expiration. All right, so that's how we can quickly assess probabilities of price going up or down, either using the put delta or the call delta. So then by using this kind of analysis, it's a very useful tool then for determining price targets to trade against, and it's very useful for then setting up hedges as well. So again, looking back at this, based on the math of probabilities, you can see that approximately 70% then of options bought, basically because out of the money, they're going to be expiring worthless. And so based on this data, it's a good idea for traders or investors to not only look at your buy side, but also consider selling options along with just buying options, okay? So by selling, by adding this kind of options, different selling strategies to your trading or investing portfolio, it's going to make a really dramatic and positive difference in your trading. Your members area, which shows you everything that you own, and you can look there to see if maybe you did buy that course, whatever. All right, so that's one thing that you can do to figure that out. Now, step 4 is something I always look to do like a number of times of the week to really give clarity to the overall markets. It's what I call top-down kind of market review. So I thought we would kind of go through and go through this review process, and this is really, to me, very important to do, just to give you clarity to the overall market and where we are within the market. So The first thing what we're going to do is kind of take a look at seasonality. Now, when we get into this time of year, there's a really strong seasonality component to the market, okay? So when we get to the end of June, where we are currently, let me get this drawing tool. When we get to the end of June, now this is the S&P 500 September continuation contract. So when we get to the end of June, which we obviously are, there's a strong seasonal bid to the market up into the middle of July. All right, so this basically a number of different reasons. You get a lot of fund flow coming in because this is a really strong seasonality time frame going back. You know, it's been about 70% probability of this seasonal trend going way back for going back, you know, like 28, 30 years. And it starts like the end of June and again goes to that kind of mid-July period. Now, a lot of it's based on seasonal fund inflows. The market knows it's the sweet spot. And then also the anticipation of the new earnings season coming up, anticipating, you know, positive earnings, different things like that also drives this seasonal trend up as well. Now, once you though get to the middle part of July though, and through the earnings season, then you start getting the market starts to stall out because of, you know, you get the profit taking coming in and you get the kind of the vacation lulls. So you have Europe pretty much is closed down when you get into the, you know, August, September period or early August. So that's when the markets tend to go sideways to down. But this is a very strong seasonal time frame. So barring any major catastrophe, this is something that you want to be aware of and understand this can be a trend and a bid to the back of the market. Now let's take a look now at just kind of the top down of the market. So we'll use the S&P 500. So what I like to do is first kind of get the macro big picture. And so I will go out to the monthly time frame for that. Now, you know, before we had all these great technicals and stuff, we used to use, you know, macro fundamentals. We, you know, talk to all the different people in our offices, different places around the world, get an idea if the markets are strong from oil or whatever we're looking at. But now we've got these charts. So you can see here, if you just look at, you know, just whatever indicators you're using, I like to use certain specific moving averages, but based on the key moving averages I use, this is 8 exponential, that purple, and the yellow is 21. You can see we've been in a very strong uptrend. So you can see how it's really been holding this 8 exponential. Look at that. Very strong to the upside. Now, finally, we started getting some momentum starting to come off. See this? So we've had this divergence and momentum as prices going up on the monthly, but it's starting to come back up again as well. So it kind of neutralizes the market momentum, but we did make new highs. So we've got this 21. You can see that's been good support. And so right now, the macro trend from the momentum is neutral, but the trend is still very much intact to the upside. So I like, you know, using that 21 as my major trend. That is still very much to the upside and very strong now back over the 8 exponential. Plus we have that seasonality potential benefit as well. So that's a look there. And then we drop it down to the next time frame called the long term using the weekly. And now you can see where we are. We've just made new highs, right? And so we've got now a good positive momentum. Look at the momentum cycle 1, which is my fast momentum indicator. 2 is positive, which confirms that. That's a confirming momentum indicator. And we're really nicely poised above the 50 weekly, right there, that green, and above the 21, above the cluster of moving averages. So we've got this cluster that we're above. And your next support really area right now is this kind of 60, 28, 29. And that is basically a gap that I'll show you that we had this past week. So we've got good support here initially, right where we are right there. You can see that support coming in. If I can, 1 second here. All right, so you can see this support coming in. See, this is what I call price action support. See that? So we came up here, couldn't get above that 6,000 basically. See that? Got above for a little short period of time. This is a weekly, remember? Came back off, but stayed around that 21, held trend, came back up, broke back above, failed again. Okay, so these are the highs that we just broke. and then we started chipping away. So here we chip, 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 broke. It's like a tree branch, or hit, finally weakens, breaks it. Now the key going forward is we're going to probably at some point we'll get a pullback, a snapback to where it broke out. So what we're going to be looking for next is this area right here. So this is a gap area that I'll be looking at for potential support, plus this. Hold on a second. Now we also have cycle momentum, and cycle 1 and 2 are positive. Okay. Now let me show you on another chart an area that I'm looking at that's going to be support based. So if I drop this down to a daily here, you can see there's a gap right here. Let me blow this up a little bit more. See this gap? So it gapped up here. This was on the 23rd. It had that gap up. And so now your support, this will be your support. This is how you can plan out, map out your support. First support, big support, is going to be here, about 60, 62. Okay, so that's going to be these highs right there, right? So 60, 62, and then the next big area will be this gap. So if it comes down here, though, more than likely it's going to want to fill the gap. Markets love to fill gaps, and that's going to be about 60, 28. Okay, so those are some key points to be looking at currently. All right, so the market, has this move up. Now it's going to be starting to get a little bit overbought, overextended. But the thing too that can, how markets go when we're to the upside, you can stay overbought. We're getting slightly overbought. We're starting to lose a little momentum, but there's what we call the wall of worry, right? The markets can just grind up because of the wall of worry. Oh, tariffs are going to come back in. We're going to have something happen with Iran. So people stay short. Hedges are on. So you've got that wall of worry plus FOMO, fear of missing out. We've had these breakouts. There are funds and institutions that are not long enough. So we've got all that can keep this thing grinding. All right. So that's what you want to be aware of. But we are starting to get a little bit stretched, nothing too extreme, and we are starting to get overbought, but not to super extreme levels. So we'll talk about this a little bit more. So this is one of the indicators we'll be using at the course next week. This is my extreme range band indicator that shows us when markets get too stretched or too stretched to the upside or downside, too overbought. So right now the market, we could get these little pullbacks, but there's a good solid support to the market currently when we look at the various support points. Okay. And then also looking at seasonality. So wanted to kind of, step through that, and we can, if we have time at the end of this, we can, go over more of the seasonality and stocks and things like that. All right, so that's kind of a look there. Now, then step 5 is knowing then when it's time to sell. So this is where we come into the 2 indicators we'll be using for the course next week, and this will be based on using my cycle reversal indicator and my extreme range band. Now, these 2 indicators, when put together, really form a great tool for identifying, places where markets are starting to get too stretched to the upside or too stretched to the downside, and they start getting what we call either maybe buying exhaustion on the upside, which leads to a cycle reversal down, or selling exhaustion to the downside, which leads to a bear to bull reversal. So you can see here, just for example, the market sold off pretty hard. This is in the S&P, and then you get what we call, exhaustion. So you can see it came down here. This is a long-term chart, and it got down here to this area. You start losing sellers, selling exhaustion, and you get what we call the cycle reversal by this indicator here, where it crosses this moving average part of the indicator. All right, and the market, you can see, reverses up. So it got stretched to the downside. These are my extreme range bands that show you how far the markets get stretched, either 1 to 2 to 3 ATR. And so when they start getting that kind of stretched out area, that's where we start we're careful about the market. And then we get these extremely overbought, where the moving average of this reversal indicator comes into overbought, and it crosses. That's when we get a pullback. Now we're not there yet, so we still have potential to just keep grinding up. So here's that indicator now. You can see, kind of get an idea of, you know, what we are doing now using the same time frame. So here's the weekly of the S&P 500, the one I just showed you, and we're not even close to being at extremes here on the weekly. All right, so here's the weekly. This is 2 ATR, that's 3. We're not even close to it. Now we are just overbought on the indicator itself, but not on the moving average. Okay, so look at the difference. Here we are currently, and here it was back in this example back here. So up here, it got over that 2 ATR and look down below. You can see how stretched it was, and then it crossed the moving average, and then we had the pullback. All right, same here. Got way stretched, got way overbought. We had the pullback. Same here. See the same thing. Now, currently, just one last picture. We're not even there. We're not even close. All right. Now that doesn't mean that we can't crash and burn tomorrow, but just looking at these technicals, there's still, what I'm trying to point out, there's still potential to grind higher. Okay. Now on the daily time frame, that's where we are getting a little stretched. So you could get a, you know, short term, a little bit more intermediate, medium term pullback. Okay. So this is where we can then kind of, you know, work the cycles. So we're starting to get a little bit more overstretched here. See the indicator down below? So once we get that 14 period moving average right here, see how it goes sideways? Look at this. Let me pull this up. Come on. There we go. All right, so see, this is over 90 percentile overbought. This is the indicator that in white. So it's overbought, but the key that I like to look at is this is the 14 period moving average of that indicator. Now, when it starts to get really overbought, that part of the indicator, that's when I really look for the markets to potentially start getting exhausted. So you can see this example here, right here, was at the 3 ATR on the daily, and you had it super overbought. And finally, we get a pullback, not a big one, but a pullback to the 21. That's your kind of mean reversion. And then we've been just grinding up. See how we've been just grinding? We're getting these little, you know, reversals, but the market's just been grinding sideways. And then we finally got some catalyst news last week, a lot of really good news to the market, and that broke us to the next level up. And now in the short term, though, we're starting to get a little bit overstretched. We could still go grind a little bit higher, but I'll be looking at this 14 period moving average. When that starts crossing, that's when we can probably do some counter trend shorts. All right, and that's where we can then start using credit spreads, things that we're going to talk about here in a minute. Okay, so that's a look there. And then here's a look on the daily. You can see this is the same indicator I just showed you, and you're going to get this indicator with the course. You can see here, we start getting these reversals, clusters, starts crossing here, we get a pullback. Right here, we get a pullback, okay? Here it is for QQQ, weekly right here, look how stretched it got there. Pullback, okay? Here it is on the daily, you can see up here. So we'll go through this indicator more detail in the course, but this is a really good kind of bird's eye view of it. And this is here, just you can see real quick on QQQ on the daily, it got really stretched here, went above that 3 ATR. We get the reversals here, and we get a pullback. All right, so you can't trade blind, and these indicators are going to really help to navigate the market. Now, next, step 6 is selecting the right option strategy, income strategy. So think about it. One major goal for you as a trader should be to be selecting trades based on what's going to provide you the most consistent positive returns with low defined risk, and not looking just to hit that home run on every trade. Okay, so you want to be just chipping away, and so that's what we kind of do at Power Cycle Trading. We're doing low defined risk kind of option spread trades that we know that are risk when we go in. So if it doesn't work out, we've got a very low amount of risk that we could potentially lose. But if they do work, we've got a great positive risk ratio to that risk. We've got a positive ratio that's greater than our risk, okay? So we'll go through how that works. So the way then to achieve this, to understand how to do this, is then to understand what are the best option strategies that are available to you, how they work, and then select the one that's going to be best suited for your trading style, the market environment you're in. So your style could be you're not wanting to stare at the screen all day, or you might have a smaller account, so your risk profile is going to be a lot more concerned with risk, as far as amount of money you could lose versus if you're having a big capital account, things like that. Everybody's going to be different. All right, so we're gonna touch here on these spreads. Now, in the course next week, though, I'm gonna go into detail on all these specific spreads. Okay, so today we're gonna touch on them, but then in the course you're gonna learn basically how to master these. Okay, so we're gonna go through the vertical credit spread, the iron condor spread, the long condor, opportunistic hedging, and then the protective collar. So we're gonna touch on all of these here today, and then the course will be dedicated to really getting into these where you guys and gals are going to be very, very comfortable with these types of trades. And remember that if you use that special link, you're going to get all this stuff and the tools to learn all this for just $167. Or if you want to do my alert service, you're going to learn it all for that. Plus, then you throw in the alerts if you want to follow along, and it's $507. So it's a great deal, and you're going to learn a lot in this course. And it's live, but it's recorded. So if you miss part of it or can't make it, you're going to get it plus all the tools. So the first one is your vertical credit spread. So within these credit spreads, there are kind of three specific ones. There's what we call the bear call credit spread, the bull put credit spread, and then there's what we call the long iron condor. All right, so these are the specific ones, and these are what I refer to as probability trades. If you think back on the example of option delta, you could see that if you did went out a 16 delta, the theoretical probability then was 84%. So we call it a probability trade. Now the first one, and very popular to use, is a bear call credit spread. So this is one that you're going to use if you think the market's going to go lower to sideways. It doesn't have to go straight down. It could just churn sideways. So if you look at this, market here where we've been, that's been a pretty good kind of spread. Look, just going sideways. So think about it. If you're turning sideways, and if you sell credit, boom, 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 it just expires. It just has that time decay. So it can make money if the market over time stays stagnant or goes down. You're selling one call, and at the same time, though, buying another call with a higher strike that protects your upside. So your potential risk is limited and capped by that upside call you buy. And these are done in the same option series. So here's just kind of a profile diagram of what it would look like. And these are what we call negative risk ratios. So you're risking more than what you're going to make. So for example, in this example, this is like on the NASDAQ NDX. So you'd be in this example selling a call here. This is like the 10-20 strike. You'd be short, okay? Now you're not going to be naked short. We're doing spreads, so we're going to be protecting the upside. If this thing would rip back up, we're going to have a call above it that we bought here in this example at 10.30. So if you look at this 10.20 to 10.30, that's $10 wide, right? Now remember, one option contract is equivalent to 100 shares. So if you multiply this by 10, this is going to be, the spread is going to be $1,000, okay? From 10.20 to 10.30, that's $1,000 wide spread. And if you did this credit spread where you sold this short, this 11.20 strike right there, and that had a 20 delta when you sold it, okay? So you sold that strike, and when you sold it, that was the 20 delta, then theoretically you're going into this trade with an 80% probability of this being a winning trade, okay, theoretically. So with this trade, then you collected a premium of $200, that goes right into your account, and then you have to put up, though, the margin for the difference, which is your risk in case you're wrong, and that would be $800, okay? So the spread is at $10 wider, $1,000. You receive $200, that's your potential profit, your credit received, Your risk is 800, so that's going to be your margin in case you're wrong. The broker wants that. So that's why we call it negative risk ratio. You're risking $4 to make $1, so that'd be a 25% return if you kept that 200 over 800. And that's about what you get. When you go out and you're doing these kind of the theoretical standard deviation, 25, it could be 20, 25, 30% return, all right? So that's a typical something that you would get there. Now here's an example of one that we had on SPX, just to kind of go through the steps. So here was SPX again, and it was trading really, look at that, talking about a grind up, look at this. And now this is a weekly, so look at this. This has been just grinding for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. Amazing, okay? But look what started to happen. So this is another indicator that I use. It's momentum based, okay? But look what happened. We start getting these reversals, but it's still grinding higher. Above that shows you super strength. It's above that 3 ATR. Now finally, the market starts to get some exhaustion. And look at the moving average. The 14th period is way above that 90 percentile. All right, so this is where we're waiting and looking for this to really stall out. So that weekly is showing you that, and then you drop it down to the daily, and it's going to really define that cycle starting to turn. So here's the daily. You can see it really starting to turn. You can see the momentum here. The momentum indicators were going negative here. So the market was starting to go sideways. So you could have done a bear call credit spread here, but we had waited for a little bit more confirmation. And so we sold it when it started to turn here. It started breaking these moving averages. You can see it right here. It was starting to break that 21. So we sold a bear call credit spread, 1 standard deviation out of the money. That at that time was 52.65. Okay, so this trade setup was based on that kind of extension, overbought, stretched out market. So we went out and sold this credit spread to take advantage of if it just went sideways. So our short strike was the 52.65. So we sold the 52.65, bought the 52.70. So we're short here, and then bought the call here to protect upside. So that's 52.65. That was a 17 delta when that was shorted. So that going in was an 83 probability, just looking at theoretical probabilities. All right, so set that up, brought in $100, $1 credit or $100. And then typically, look to take 70, 80% profit. And so it dropped down to 30 bucks, bought it back, had a profit of 70 bucks per spread, 18% return. And this one 2 days because it pulled back pretty good. All right, so that's a look there at kind of a bear call credit spread, playing market cycles on that trade there. Now, the next one is your bull put credit spread. And in the course, we're going to go through that in much greater detail of how to look at the deltas, pick the strikes, and what option series. The timing of it is also critical. How far out do you go? Now, the next one is your bull put credit spread. So this is one you're going to use if you think the market's usually going to go up. But again, it could just go sideways and you're still going to make money. So it can make money over time even if the stock stays stagnant. So you're basically, what you're doing is you're selling one put, further out of the money, like at 1 standard deviation, and at the same time buying another put lower in case the market keeps going down to protect your downside. So, and you're doing it also in the same option series. So again, this will have a negative risk ratio. So here's an example, like on Apple. So Apple here, was this was selling like the 149, selling the short the 149 put. This had a minus 20 delta when it was shorted. So here was the put. So short that put, okay, and then bought against that the 144 down here. So in case the market collapsed down, you're still covered to the downside. You're not naked short a put. So the spread width here is $5 wide. So you can see the spread width, 149 and 144. So your short put is at 149, long put 144, $5 wide. Now with this one, received a credit in this trade of $105. Okay, so the spread width is 5, which is $500, right? Received a credit of 105. So that's what you're going to keep, that premium. Now the broker though is going to want your margin, the difference in case you're wrong, of 395. All right, so that's your margin, your risk, and so here you can see you're risking $3.76 to make $1. So negative risk ratio. So again, this would be about a 26% return on that type of credit spread. So these are, again, probability trades, but that's a really good kind of profile of what you can expect. And again, we're going to be, going into these in much greater detail in the course. So here's an example of one that we'd set up. And again, this was very stretched. This was NVIDIA, and this was a cycle low reversal. This is where it came way down here, and it was having a pretty good sell-off. And then look how extreme it got. It got to that 3A chart. It was really stretched to the downside. And then we finally started stalling out on selling exhaustion, cycle reversal, started to go back up. We sold a bear call credit spread right when it started to reverse. So that's a really good play right when markets are starting to reverse down or reverse up. And then we can add other types of trades to it as well. But probability trade, so very high probability trade down here where you're getting super stretched, we're getting a reversal, super high probability. So think about this. If you've got a system that's 50-50 and you've got the probability that this 80% probability, what if you had a system that's right 70% of the time or even more? So then you even increase that probability more than if you're just flipping a coin 50-50, right? So that's why these indicators are really helpful, because they make these probability trades even higher probability of them being a successful trade. So these tools are important to have. So here's then one that on NVIDIA, and so went out and sold here, sold the short the 84 put right here. So we're looking for a bullish trade up. The market's coming down, starting to reverse. So we sold the out of the money bull put credit spread. This had a 20 delta. So going in then that would be giving us a 80% probability. So shorted that 84 put to protect it, bought the 80 put. So we had this $4 wide spread, okay, 84.80, and this ended up, up 94. So bought it back for a penny, and so had a profit of $94 per spread, 30% return on the risk there of your margin. All right, so that's kind of a really typical look of what you could expect, from a bull put credit spread. And then the next one is what we call the iron condor credit spread. This is basically a combination of the two together, okay? So it's the combination of your bull put credit spread and a bear call credit spread. So when you feel that a stock or security is going to trade in a very tight range or kind of be stuck in a range between two strike prices and stagnate, then this strategy is a great way to collect premium. And also at the same time, you're having you're capping your risk, having it as a spread. So this is again is going to take advantage of sideways market, take advantage of that time decay and volatility crush of your options as they go into expiration. All right, so here's basically your typical iron condor credit spread is going to be a combination of two credit spreads, combination of your bear call credit spread and a bull put credit spread. So the credit received is your profit. So if you sold a credit spread, you received $50 on this side, $50 on that side. Your total potential profit would just be that credit received of 100, versus your spread width. Let's say your spread width was $100. So then you've got your potential risk of 300. So that's typical on how these work. Okay. And they're called long because you're short the body, long the wings. That's how brokers quote a market. All right. So here's one that we had set up. This was, and these are great for legging, right? So if you have maybe a big push down, you want to sell the bull put credit spread first and you're expected to move back up, or the other way around. This one is one that we did on Tesla and legged it doing the bull put credit spread first. So this one started out shorting the bull put credit spread. So it was trading at 243.30. So sold the 237.5, 235 bull put credit spread first right here. And that 237.5 was a minus 20 delta when it was shorted, okay, 80% probability, just to show you the probabilities. And so that was put on for 60 bucks credit. And then you can see here it was, down to 14. So if you'd covered there, you would have made $46 or 24% return. So that was the bull put credit spread side. When the market, Tesla was down, then it was turning up, sold that right away. Okay, so this is kind of a typical thing that you can look at. We'll go through this in more detail again, like I said, in the course with different examples. And then when it started to push back up and then stall out a little bit on the upside, then sold the bear call credit spread here to complete the Condor. All right, so then, and then when this was shorted, this was selling at 267.5, 270. That short strike was at 23 delta. So, the probability there 77%. So then short that call, long the call, okay, short that 267.5 call, and then bought the call above it, the 270, brought in 38 bucks, okay? All right, so the combination though of those two together, that gives you your total max premium from the two spreads, and that's how the Iron Condor basically works. So here you're short that 267.5, 270 call, and that, just kind of showing the probability that had a 23 delta, the short strike, and the 237.5, 235. This was done first. That had about a 20 delta. So the spread width here, you can see between the two spreads was $2.50, right? 267, 270, 237.5, 230. So spread width of $250, and you received a total premium of 98. Okay, so then your potential profit is your premium received in 98, but your potential risk though is capped at 152. So it's your spread width 250 less your premium received. So if things went against you and it really ripped to the upside or downside, you still know your max risk is 152. And then we'll go through how to play stops and how to use stop losses on these credit spreads as well. There are a number of different rules that I like to use to kind of teach you how to control your stop. So what you want to do in these types, we call it kind of a campaign. You never, never, never want to lose your full at risk, okay? So that's why we call it kind of a campaign trade, and we'll go through how that works and why it is in the course. But that's kind of an overview there of that. Okay, so there's your Iron Condor, what it looks like. You had the short call credit spread here. You started out with the bull put, so you can leg in, you can leg out, or you can put it in all at once. Went out right perfect, right in the middle. That's where we want it. So you can see your credit there is 60. Bought that back at $4. So there was your return on that. You had 56 bucks on that profit, and then you had your 38. Bought that back at $3. You had your 35 bucks there. So you had your profit of 91. On that risk of 152, so 60% return on that. So that's your typical Iron Condor that you can play when markets are going sideways. Now the next one is one that we do a lot of these. These are long condors, okay? So not to be confused. So huge difference, and these give you a positive risk ratio, okay? These are great spreads, so we'll go through how these work. So instead of being short two credit spreads, instead of that, we're going to have a debit spread with a credit spread. So we have the potential to make the big profit from the debit spread side, and we're offsetting a lot of the risk with the credit spread side. So for example, in this one I'll show you here in a minute, we're long a call, short a call. So we're long a call debit spread, and then we offset our risk and our theta by selling another credit spread against it further out of the money. Okay, so they're not two credit spreads. That's an Iron Condor, and you could do this with puts or calls. Okay, so we do a lot of these trades, and we'll go through the stats of these in a minute. So here's one we did just recently. This was on Palantir, so it was trading right here at 123, and so it's trading right here. So based on our indicators, they were starting to move up. Some other things we're looking at, it was breaking key resistance here. See that dashed green line? That was the prior week's high. So we went out here and we kept our risk super low though by doing it as a condor. So it went from 123, then we had a profit there on the 16th. It was up to 128.88. So this was the long condor. And hold on one second here. Yeah, Charlie, use this special link here, powercycletrading.com if you happen to go, and then use that, click it, or copy and paste it, and then to get the discount 15 off, use sell 15. All right, and that'll get you covered there. Yeah, thanks for asking. All right, so here was the trade setup, what it would look like, and then here's the long condor. And so this is one that we're going to be covering in great detail in the course. This is one of our favorites to use. So here you can see we had a 125, 127 called debit spread, and then we offset a big chunk of the risk, improved our theta, make it positive. So we sold the 136, 138 against it. So we ended up with this kind of profile structure, what it looked like there. All right. No, that's, this is a really great discount, and it's all changed. That's going back pretty far, 2017. God, I think it'd be, worth your while. To 167 is the best I can do. But remember, with your members discount, there's a lot of stuff on the website that if you want to get, but even if you go to the website, this course would be a lot more expensive on the website, even if you use your 60% off, plus you're not going to get your additional bonuses, right? All right, so let me just clear this out. All right, so that's what you have here. So then you see your spread width, it's $2 wide, 125, 127, 136, 138. So it's a balance, what we call balance. Your total risk is $72, 72 cents, 72. So the potential, if it goes out between your spreads in here, you would make $128 per spread. That's 177% return. All right, so these are, just chipping away. I mean, that's not a bad return. Now, we've had much bigger returns, as you're going to see here in a minute. We had a Dell trade just last week where we made over 800%, I believe. I'll show you that here in a minute. Okay, but this is typical of a condor, and this is a call condor. We also do it the put side when the markets are going down. So here's what it looked like here on the profile. All right, so we had this long call debit spread side, had the credit spread side. We had total cost in the trade of $72, and it went out right here, right perfect. So we had spread with the 200, cost of the trade. So this actually ended up max profit 128, and that's 177% return, over that basically 3-day period. Now here's the next thing that we'll be covering real extensively, and this is the what I call opportunistic hedging. And by combining these spreads, we can really do some great hedging where a lot of times we can reduce our risk really down, very, very low. And then sometimes we can reduce it so much we turn it into where we have no risk at all, and we can adjust it to a free trade. All right, so this is what I'm constantly looking for. If we can, if we can do an adjustment where it reduces our risk, and sometimes, again, we can reduce our risk all the way down to zero in a free trade. So here's an example of one where we had QQQ, and we started out with this one with a long put debit spread, and then we're able to adjust it by adding a bull put credit spread into a free trade. All right, so follow me on this kind of progression. So we had this QQQ set up. The market was trading at 365. It was going down. We were looking for a break and a bigger move lower. So it was starting to break these key areas of Fibonacci support. So it's right here, and it was breaking this 365 area right there. So right there, you can see that 366, that was 50% retracement. So it's starting to break that. We had negative momentum. These are things I look at. So we're looking for a potential big downside move, and we're kind of targeting down to this area of 355, which you'll see here in a minute. There was big support back here, you'll see. So the first trade setup, we did the put debit spread, and then we made an adjustment. This was on the 28th, and then we adjusted on the 1st when it really ripped hard down. It was trading down here at 354.53. We added a bull put credit spread, reducing our risk to 0, and then we had profit. You know, it was on the 6th, max profit. Okay, so here's this. This again is what I call this kind of hedging, which we can really take advantage of, and opportunistic hedging. Okay, so the first trade one, we had a really good put debit spread set up. Trade one was trading at 359.60, and so we went out, we bought the 6th October 360 put right here. So we were long this put here, short the put, really nice debit spread, $4 wide. Our risk was $121 on the spread, so $1.21. And let me see here 1 second. Okay, so then the trade, if we close below the short strike of 160 at expiration, this would have been up $279 or 30% return. So risking $1 to make $230. Now, what happens in a lot of times, down markets or even up markets, is what would happen was we'd get a big hard move down, and a lot of times then it would snap back up. So what we started doing was doing this spread strategy. So we'd be long the put spread, and then when it ripped down, we'd sell the bull put credit spread against it, bringing in big premium, and then offsetting the debit spread side, and then we'd sit with the trade. Okay, so then trade two, the market collapsed. Okay, so trade two, the market collapsed, and it was trading now at 354.53. So when it did that, we sold within the same series. We sold the 354 put, bought the 350. So $4 wide spread, and we brought in $141 premium. All right, so that offset our debit cost of 121. So trade one, we had 360 put debit spread, and then when it ripped down, we legged into it by selling 354.50, $1.41. So look, recouped our full debit, but we actually ended up with a credit. So in this case, we had a credit. So even if it went up or down past our long legs, we would have made 20 bucks. We went out right here, we made 420. We made max profit on that trade. So we made the 400 plus the credit received at 20, and that was a super great trade, you know, as far as managing risk. So that's another big thing we'll be covering in the course. Now, the next one that we're going to also cover, and this is a really good one that would be very advantageous to be using right now, is what we call the protective collar. So I'll be teaching this in the course in more great detail. Plus, if you do have something, a portfolio that you want to hedge, bring it to the course, and we'll outline and structure a trade setup for you. But the protective collar is one that we'll cover in the course. This is actually one that we're going to do. What we do is double verticals is what I call it. But this one combines two option strategies. It gives you the protective put with the covered call. Okay, so basically a protective put, or you might hear it called a married put, involves being long a put option and long the stock. Okay, so that's a married put. So you're long the stock, but then you're long a put below it to protect the downside. Now the covered call, you probably know what this is where you're long the stock but short a call against it. Now when you put the two together, this then creates what we call the protective collar. Now we can also do this even without you owning the stock, so it could be your stock portfolio, and that's what we're going to I'll teach you how to do in the course. So think about this. If you don't understand it, so think about if the stock goes down and you're short a call against it. Let me get this. Okay, so if you're short a call, let's say you own a stock, you're $100, and then you shorted a call at 150 above it. Okay, now if the stock goes down, the value of your call will go down in value. Let's say you brought in $100 premium, so that premium, it goes down, right? Because you shorted that. That's going to then allow you to buy that call back cheaper if you want, giving you a profit on the call option. or most likely, if it could just expire worthless, so you keep the full premium. Now, remember, you sold the call option short at a higher price than your stock, all right? So that's your covered call. Now, the other part of the trade is you're going to be long a put. So if you're long a put and the market goes down, what happens? The value of that put goes up, right? So you've got the combination of your value, you're getting money, your premium collection, you're getting money, collecting money on the short call. And if the market's going down, you're also getting money, market value of your puts going up on that. So that's going to then offset your stock going down. So that's what we call a protective collar, all right? Or we can do these as an aggressive way to make money with the double verticals, all right? So it's a really cool strategy. So here's an example. So Joe, he owns 500 shares of XYZ, and he bought these shares for 40 bucks a share. Now, on the 23rd of May, his stock was trading at $45 per share. He bought them at 40, so he had a pretty good profit in here. So he wanted to kind of protect that and hedge that. So that position, because markets were starting to get, really uncertain and a lot of volatility was starting to come back in. So he wanted to make sure he was protecting that 40 bucks. So what he did, he went out and he bought 5 of the June 27 weekly put options. And for that, he had to pay $39. It was 39 cents or 39 bucks per option contract. Okay. Now, I'm sorry, he bought the 39 put. That was below that 40. Okay. And he had to pay 90 cents per option contract. And then he also, at the same time, though, he sold 5 of the same series, 27 June weekly calls on the 49. So he was long, let me erase this. So he was long the $40 shares, and then he sold against it $49 call, okay? And he bought below it the $39 put. So that's what we call a collar, all right? And so this is the math, we'll look at it. And so he received $1.10 per option contract for selling those 49 calls. So he financed a big chunk or all of his puts. All right, so this is a really great strategy that we're going to cover next week, next Saturday. Plus, this is for stocks or a portfolio. I'll show you how to do it for a portfolio. Now, so you can see then he had his 500 shares of it at 40 bucks. Then he had bought the 39 put. He had to pay 90 cents or 90 bucks, and then he sold the 49 call. He received $1.10 or 110 bucks. So now he basically did this, financed it, and he had actually a credit for doing this. Now his break even then went from 40 minus 20 down to 39.80. So his max profit on the stock then would be capped, but anything above 49, that was his max. 49 and above was capped at 49. So if it went to 49, you had those 105 contracts times 100 to make it the multiplier. And at 49 plus the credit received at 20, less the cost of the stock. So he would have made 4,600 bucks at 49 or higher. He was capped. That's a 23% return on his risk of $40 per share. Okay, so not a bad return. Now, but he capped his downside risk by doing the put side. So he had 5 contracts of those times the multiplier. So 40 less the 39 plus the credit. So if you go through the math, then his maximum, he had his max risk of 400 bucks to the downside or lose 2%. So potential 23% to the upside, 2% to the downside. And Joe is feeling a lot better at night sleeping that way. So, think about where we are now. This is a great strategy to start implementing. So if you'd like to learn how to master the option income profits hedging, please sign up here now today, and you're going to get everything I showed you. Instead of $197, you'll be getting all this for $167 today. And we'll go through everything again and take questions, and just use that link, click on it or copy and paste, and then use cell 15, and that'll get you there. And then we'll go through the course outline. I'll show you what we're going to cover in the course in more detail. So this will be start next Saturday, okay? So at 11 a.m. to 1 p.m. So we'll just go, 2 hours, because it's a holiday weekend. Then we'll finish up Monday the 7th, and we'll do a Q&A the next day. that will be dedicated to this course. Okay, so with this course, you're going to get these additional bonuses, which are important because we'll be using these in the course. So you'll be using the cycle reversal indicator. You're going to get that, the extreme range band indicator. So if you check out my site, those are $197. Plus for what I call price target mapping, setting our targets up and above for profit take and stop losses, which are important. This is my all new Fibonacci course, which I just completed this past month. You'll get that as an additional bonus. You'll get in package 1 30-day trial membership to the trading club, which gives you access to our trading room, Q&As, a lot of good stuff, which we'll talk about. And so that we've got different price points for it, but this is, if you do it month to month, it's 97, but you'll get the next 30 days for free on this. And you can start this whenever you want. You don't have to start today. You can start after the course or whenever. And then we'll do a follow-up Q&A on this course. And then you're also going to get another option kind of tutorial, my option tutorial, with a lot of really good stuff in there you're going to like. So the total bonuses here, $1,200 over $1,200. So course package 1, $2,800 basically. That's with the 167 price, that's a great deal. 197, you're 167, 94% off with all the additional bonuses, which we'll be using in the courses to make this more understandable and successful for you. And then if you want to add the alert service, will be for the next 4 months, which also gives you my trading club membership for 4 months. And you can stop and start this whenever you want. You can do it manually yourself. So if you go on vacation, whatever, you can start and stop. So with this, you get the 5 different alerts that I send out, all right, for the next 5 months, or 4 months, excuse me. So it could be a butterfly or a condor. We do a lot of those, a lot of condors, okay? So that's what we're covering in the course. Or it could be counter diagonals. Could be it could be a pinning trade, what we call it when we're pinning. Or it could be a breakout reversal credit spreads, which we'll cover in the course. Or it could be a selective earnings trade. So these are 5 different types of trades that might be sent out depending on what the market is doing. Okay, so that gives you access to those for the next 4 months there, plus the trading club. And then there are typically 8 to 12 stocks or ETFs I'll send out per month. You'll get a trading guide for each one, that comes through the alert. We use what we call Telegram. Okay, so we use this alert service here. Telegram, it goes out instantly. We had, a couple trades. We had a Dell, and we had Boston Scientific. We had a number of things that we were doing last week. But, that's what we use, and it's a free site that you can use for that. And I want to make sure I didn't miss any questions here. Everybody, any further questions here? John, yeah, got that. I think I've got everything covered. All right, so that's what you're going to get there, and then you'll have my access to the weekly Q&As for the next 4 months. I send out a daily video newsletter every day after the close during the week, so you have that 4 months, and access to my virtual trading room, from 9:30 to 10:30 Eastern every day during the week. So come on in there, ask questions on any trades that you have, or see what we're doing there, and then discounts on any software or trading courses. You get that 60% off there. So that's what you're going to get there. Just use that special code. And again, you're going to get all that today instead of $597. When I go out to my list, you're going to get today for $507. And so that'll include the course again, the indicators, and all the bonuses, everything in course package 1, plus the alerts for 4 months, and you can start and stop whenever you want. All right, so that's, again, you can find out if you have it. Now, if you maybe have these indicators already, these are just part of the course because we're going to use these in the course. So these are just, additional add-ons to that 167 price, but they're, going to be really great tools for you to use for this course plus in the future. Yeah, yeah, Shams, hold on 1 second. Bear with me 1 second here. All right. Okay, so that's what we're doing there now. Just kind of going through the alert service, kind of the summary. I kind of touched on this earlier, but we're going to go through all the different bonuses. But the alert service, if you do want to add this, you can see we've had since 2018. Now we have 4 or 5 different alerts I've sent out. Started the first one back in May of 2018, but we're maintaining around a 79%, around that win rate, which is really important. So we've had 889 trades closed out, 639 winners, 61 break even, 189 losers. And again, these are just summary on unaudited results there. And then here's just this was so nice from Pam, one of my members. She said, just sending a quick note of thanks that you can maybe pass along to Larry for all the fabulous teaching through the years. I truly have enjoyed learning from him and the other traders in the trade room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to trade than for Larry Gaines. So thank you so much if you're here, Pam. And here's what we're going to cover, an outline of the course. So it's going to be a really, really great course. So we'll start again, like I said, next Saturday, finish up on the 7th, which is Monday, and we'll do a dedicated Q&A to it the next day. So live and recorded if you can't make it live or miss parts of it. But the first part, we're going to start out with the option Greeks that are vital to understand how to use for selling credit spreads and selling options. Then we're going to get into more on option delta, trade probabilities, how to use those in your trades. And I'll give you what I use for my option selling guidelines and rules, that I have. And so this will be a printout. You can have black and white rules that I like to follow. Then you will look at the pricing of the options, how they're affecting time and volatility, how that affects your price. We'll go through the price target mapping. This is a brand new course that I just finished, but we're going to use this for setting up our targets. And so we'll touch on how that's used. And this is also a bonus part of the course as well. You get this. And then what are the best time frames to use if you're doing credit spreads or any of these types of spreads? Should you go out 1 week, 2 weeks, a month, whatever? So we'll go through how to set your timing for spreads or time frames, your duration, how to know which ones to use. And then we're going to go through using the cycle reversal and the extreme range band indicator to help us signal when it's time to sell. So this is going to be a really key tool that we'll use in the course. And then part 2, we're going to get into the best for selling strategies to use. So question, how long will you have the indicator? These are yours forever. So the question is, how long will you have access to the indicators? These are yours. You'll get the download for them, whatever platform. We have Thinkorswim, TradeStation, TradingView, ESO. I just have to double check, but whatever platform we have them for, it's yours forever. And you can have, if you have multiple platforms, if we have the indicator for your platform, you can have it for whatever platforms you have. And there are no additional fees, as far as any license or anything like that. It's yours, okay? So that's part of the bonus. So good question there. And yeah, here's that link one more time, Georgia. And yeah, thanks for the question on that, Sandra. So again, these tools are really great. And we use these tools for every trade. If you come in the trade room, you're going to see all of our trades are, kind of based with these tools in mind. So then we'll go through part 2. We'll be going through these specific selling option strategies. We're going to go through step-by-step guide on how and when to set up a bear call credit spread or a bull put credit spread or the iron condor. So when would you use the bear call versus the bull call credit spread versus the iron condor? So you're going to know when to use it, how to use it, the setups there. So what are the market conditions that are best for credit spreads? So there are a lot of traders that all they do are credit spreads, but they're missing out on all the other great trading opportunities, which we'll cover here, which will be the Condor, because their profit is just that premium. But we're going to go through using credit spreads. We're also going to start in this course showing you how to also add the other side of the spread, so you can make the Condors and things like that, so get a better return. But anyway, we'll show you the market conditions best for the credit spreads, and then which one to trade. What's the perfect time frame? So that's another really key part, is the time frame, the duration of the credit spread. Okay, so that can really create the risk or reduce the risk based on what time frame you're using. And then I'm going to go through 5 must-know rules for trading credit spreads, for how to make adjustments for credit spreads. And again, it's like I mentioned earlier, credit spreads are like a campaign. All right. So yeah, with TradingView, well, we have the instructions for it on the indicators for TradingView. So when you do have it, you'll get instructions on how to upload those indicators. Okay. And if you already have it, again, that's like, these are included in the course as a bonus, but I'm glad you already have them. But we'll be using these indicators in the course. And yeah, if you need help, contact, support at powercycletrading.com. Let me put that in. Okay, here, just do this. Oh, hey, thanks, Robert. That was really nice. Yeah, hey, thanks so much. That you made my day. So here's Robert, just bought the course. He won't be able to attend, but he bought it because it says me. Huh, that's a really nice compliment. Thank you so much. Thank you so much. 3 best, okay, 3 best. Yeah, I don't know why I have it. Yeah, you're right. Let me make a note. 3 best selling strategies. Yeah, thanks for pointing that out. This number dyslexic. Thanks for showing me that. Appreciate that too. And then, we're going to go through how and when to use the long condor. So this is such a great strategy. We use this so much. This past week, I think everything we did was pretty much based on probably around a long condor. Okay. So with this course alone is just worth the money in the course to learn this strategy. So when to use the long condor, not to be confused with the iron condor. Okay. But we're going to cover both, so you'll know which one to use. So this is a very low capital at risk strategy that often delivers 200% or greater returns with positive data, no time decay. So we'll go through the step-by-step guidelines for setting these up. And these are a combination of your vertical spreads, right? A vertical credit spread with the vertical debit spread. So it's going to increase your profit potential, lower your risk, and also reduce your theta to usually 0. So this is a great way. We do a lot of adjustments using this long condor or ratio long condor, which you'll use for hedging. Okay, so great way to hedge as well. And we'll go through the steps involved in that. And then part 3 is dedicated totally to hedging. Okay, with the perfect tools that you're going to get, we're incorporating those, but you're going to learn the hedging. So you're going to get my complete guide on hedging with options. It's kind of what I call progressions of hedging. So we'll go through how, why, and when then to use a credit spread for hedging a core trading position, or we're going to go through how, why, and when to use the Condor spread for hedging, hedging defense. All right. So a lot of times we'll be, we can leg in, leg out to these types of hedges as well. And then you're going to learn, if you're doing credit spreads, this is really great. 5 different ways to hedge a credit spread, okay? So rolling it up and out, there are a lot of different ways to hedge. The butterfly defense, we're going to go through 5 different defenses for credit spreads. And then we're going to end up with, this how to hedge your stock or your stock portfolio using the protective index collar or the double vertical option spreads, okay? So this will be a really big part of the course too. And again, if you do have a stock portfolio or something, or stock specific stock, bring it to the course next week and we can set up a hedge for you to show you how to structure it at the course. All right, so that's kind of an outline of everything there. And then just in addition, you're going to learn about assignment risk, expiration risk, how that works, auto exercise and assignment, and you'll get a trading library, which is a great way to go back and look at past trades to learn. So again, put in that special link there. If I still have it here, wait a second here. Put in that link. Let me get that one more time. What is I don't have the monthly return, but I just do the alerts in a summary. But typically, you can just kind of, we have a 79% win rate, so I'd have to really go back and look at that. I don't have that for you right here, but we have a high winning probability or high winning rate on our trades, and you'll see a few trades here. We're going to go through a few, and they're typically make $200, $300, $400, $500, and then we may lose 75 to $100 on a few. But we have such a high winning percentage that it gives you a really good rate over the course of your trading. Okay, and again, the more you see the alerts, we'll go through a couple alerts and I'll show you how those work. So here, just to spotlight the bonuses first, you'll get my cycle reversal indicator. This is a indicator I put together based on momentum and measures overbought, oversold levels, and then signals, gives you an advanced signal for a market potential reversal, typically 1 to 2 periods in advance. So it's a forward-looking indicator. It has an upper and lower study. The lower study will show you the overbought, oversold situation, the actual signal, the reversal signal, and the upper study will show you arrows that we'll set up to show you if it's a up or down reversal. And I've got this indicator. You're going to get this as a bonus. So this is available for Thinkorswim, TradeStation, TradingView. And so you can see the arrows there. That's a cycle reversal going down. Here's a cycle reversal going up. So anyway, you're going to get that as a bonus, and we'll be using this in the course for all the trade setups. And so you can see the cycle reversal here. I won't spend too much more time on it here, but that's something we'll be using in the course. And then you'll get my extreme range band indicator, which is going to be a great one to be using here because we're starting to get stretched. And this indicator identifies price extremes where price is too extended from its mean moving average, and it's an alert signal for buying or selling exhaustion. So this becomes kind of the first signal that a security is starting to reverse. So very accurate in signaling in advance potential swing trades or long-term market reversals. Available with Thinkorswim, TradeStation, eSignal, NinjaTrader. All right, so you can have that for any of those platforms. And these are the indicators that we'll be using. Okay, so then here's, I highlighted this earlier, extreme range bands here. And then the next thing you're going to get is my Fibonacci price target mapping course that I just completed this past month. It's all new. So this is based on Fibonacci and the other things that are incorporated in our moving averages, price action, support, resistance, standard deviation forecasting, and unusual option activity. So it's a combination of all this. The course shows you exactly how to use it, how I set it up. So 3-hour plus course with training manual, but this is all new. So you'll have this, on demand as part of your bonus because this is exactly what we use for setting our targets as well. And then you're going to get a 30-day trial membership to my trading club if you're not, if you do package 1. And with this, you receive access to my virtual trading room, which is open every day during the week, 9:30 to 10:30. Eastern, so come in there if you have a trade you want to look at that you need help on or see what we're doing there. Do a daily market trading video update review every day after the market close. Archived videos, we do it weekly, live and recorded Q&As. Get a trader's educational vault, 6% discounts on everything on my website that I showed you a little earlier, courses, software. And so one thing that's really great, one of my members, Jay, pointed out, he said, reading books is fine, but seeing the actual option trade setup makes a huge difference. And That's what you get with the trading room. You come in and see what we're doing, how we're working on trades, why we're doing them. It teaches you a lot there. And then we'll do a follow-up Q&A the next day after the course. And then you remember you get the 30-day trial. If you do package 1, you're going to get 4 weeks or 4 months, excuse me. And then last but not least, you're going to get an additional option course, which is my option trading tutorial, which is just going over Greeks, delta, gamma, theta, option pricing, standard deviation. So just more great option stuff. 60-page option guide with videos on that. So those are, you know, the additional bonuses that you're going to get. And again, everything will be recorded, and you'll have all that. Now let's just go through some of the alerts here. I'll show you how those work. And somebody was asking, I think, John, about how to read the alerts. So we'll go through a few more here so you can get a better idea. And I'm putting together a cheat sheet on the on the alerts, how to read them too. I thought that would help. So I'm putting a cheat sheet together on that. I'll have that out maybe this week. So Dan said you are, well, daily market updates. It's on the website. They're posted to the website. So if you're not getting the daily market updates here, make sure you go to your customer site. Just send us the email though. If you need help, go to support, again, support at powercycletrading.com. Go there and make sure Rachel will help you make sure that you have, the right information and login and stuff so you can get access to those each day. Okay, make sure to do that, and she'll take care of you right away. So here's a little feedback from Dan. He says, you're very diligent and totally thorough with your analysis. That is the foundation of your success to the alerts. And this is, what a lot of the members, have basically done. He said, I paid for my subscription with the first 4 trades I took with you when I was just learning to trade options. Please feel free to share this, to any of your participants. And then, Scott said, best investment you'll make, great group of traders as well. Now, just kind of review again what you're going to get. When I do send out an option trade, a lot of members just do their own thing. So if it's a long trade, they may just buy shares, buy calls. But on any trade that I send out, I will always give you an entry level. Okay, that's the first thing, obviously. I'll give in profit targets, usually target 1, target 2. This is based on that Fibonacci price target mapping, which you're going to get this in the course we'll use. I'll always give you the option series, stop loss guidelines, and then I'm constantly giving you alert updates and adjustments if needed. Trades are listed and archived for your review to look back on those trades. So that's kind of a basic outline of any trade. Then there's a setup video review I'll do after the close. I'll tell you a little bit more detail why I selected the trade, what we're looking for there, plus the video newsletter every day after the close. Then you're going to have access to my weekly Q&As every week during the week. We'll do that live and recorded, and then access to that virtual trading room for the next 4 months from 9:30 to 10:30 Eastern. Sometimes we go over that. And that discounts on anything on my courses or software that's on my website, Traders Educational Vault. So you get all that for the next 4 months if you do package 1. And here's just kind of a review of some trades here. Now, we do a lot of these calendar diagonals. We'll go through a few of these that we've done recently. Yeah, John, it will be. So I started this alert service back in June of 2019. Through the end of this past week, we've had 342 trades closed out, 246 winners, 21 break-evens, 75 losers, winning rate of 78%. These are unaudited summary results, but that's a summary of those trades. And we do a lot of these, and I'll show you a couple examples. Here's one that we did this past week, actually, and this one was a really unbelievable one. This could have been a lot better. I'll show you why. But anyway, this is what it looks like. So here's for Johnny. This says a new Dell long. Now we started this trade out as what we call a calendar diagonal. So I won't go through the details of it much, but we started this trade out. It was trading at Dell. We started it on the 18th. It was trading at $117. Okay, and then here was kind of the trade summary. We did this into what we call a call counter diagonal. We had our initial cost was $310 per spread. And then we did this adjustment on the 20th, okay? Now this is where we really started to really make this thing a big winner. And so now it was trading at 118.77. So what we did here was we adjusted this trade into, here it is, a long call condor, okay, right there. So it goes through how we did that, you know, it takes you through the steps. So it says here, you buy to close the 20 June. I won't spend too much time on it, but we did this trade. We adjusted it to a call condor, which I'll show you here in a minute. We initially, and as soon as we put the trade on, this thing ripped so much, we were up 110 bucks. And then on the 25th, this past week, it was trading here up at 121.50. So you can see here 117 now, it's trading 121.50. And I'm constantly sending out different alerts telling you, hey, take some profit or do this or that. But on this day, it was trading here, and I sent out this alert. I said, make sure you lock in some profit and hold balance. Currently up around $207 per spread or 828% return. Okay, now I'll show you this why in a minute. Now the adjustment we did, we were able to adjust this trade cost down to 25 bucks, okay? And that's why we had such a huge return. But that's what you can do with condors. You can do a lot of really incredible stuff, and we're going to cover these in great detail in the course, okay? So here was the trade. We started out 117 on the 18th. We did that adjustment on the 20th. Now we had it as a condor. It's trading at 118.77. On the 25th, we took some profit on the alert, 207 per spread, 828% return. And here's what the trade ended up looking like, just to kind of go through it. So when we initially did the trade, this is where we got the big advantage. We had this trade set up as a call counter diagonal, and we had $310 per spread. We were up initially 52, but then we closed out the short strike, the 20 June 120, took a big profit on that, and adjusted this into a condor. So let me show you what that ended up being. So that's why condors are so important to understand. So then we ended up doing this adjustment where we ended up long now the 116, 119 call debit spread. All right. Okay, so $3 wide, and then we sold against it. Okay, so we ended up with that, and then we sold against it to make it into condor, the 124, 127. And we had this adjusted risk down to 25 cents or $25. And we had a $3 wide spread now. Okay, so our cost then was 25. Potential, if it goes out here this past week, would be 275. We would have made over 1,000% return. So I thought this was going to be 1,000%, but then Dell spikes up, but we still made a great return. Okay, but we're capping our return. We can manage this risk, and this one you can see how low the risk was on this. So we had that risk of 25 right here. The thing blew up to, that spread blew out to $232 on that spread. So that gave us a profit per contract. So if you just did one contract, you were up 207 on the 25th. And on that risk of 25, that was an 828% return. Okay, that's, you know, one contract. If you do 10, you can see your, you know, what it looks like. This was one more example of one that we did on Oxy. And so I won't spend too much time going through it, but this was a call condor calendar again. So on the 10th, and these are the alerts that you'll get, all right, as a member if you do the alert trade part of the service. So we set this up on the 10th. Oxy trade at 43.80. On the 13th, we adjusted this one to a condor, okay? And so then on the 18th, it was up 165, 445% return. On the 20th, it was going out up 145 or 391. But this initially was set up as what we call a call counter diagonal, which we had put on at 73. But then we did this adjustment into a long call condor right here. So call spread adjusted trade to the condor. And so now we adjusted this price down to, I'll show you in a second. And then we had a profit take on the 18th. It now is trading at 46.50. And I sent out alerts saying, you know, to lock in some profit, and currently up around $165 per spread or 445% return. Make sure you lock in some profit. And then it was going out on the 20th up 45.86. So this was another long condor that we adjusted into. So it was the trade setup was right here on the 10th. And these are the alert trade kind of things that you'll be sent out. So it's trading right here. Momentum indicators were all up. Everything looked good based on what I like to look for. And then we were looking for this as your kind of resistance area here, the 150 to 200. So we adjusted this into the long call Condor on the 13th. Then on the 18th, it was trading at, we had a profit 165, up 445. The next day, it was, going out up $145 per spread. So let's go through and I'll show you what this one looked like. And then we'll look at a few more and then take any more questions. So we originally set this up as what we call the calendar diagonal. And these are the things that I teach in the trade room, and my courses are all about these. You can buy these on the website, 6% off. And so this went from, that spread when we originally set it up was 73 bucks, and now it blew out to 180. So we took some partial profit up 107, but then we converted the balance of this trade into a long call Condor. And this is why we made so much money as a return on that low capital. So again, this trade then on that adjustment, we went from the original trade, now we were long the 44 call, short the 47 call in this 20 June series, okay, long that, and then we added to it the 48.51 call credit spread, and that reduced our risk down to $37 per spread, or $37. The spread width, $300 wide. So the potential, if it goes out in here, was for a return of $263 or 710% return. All right, so here's the trade setup, and it went out. This was on the 18th. We were up here. It went from 37 to 205. So at this point in time, this was up $168 per spread, 454% return. And then the next day we closed it out. It came off a little bit, but that's kind of where it was, and constantly updating these trades so you're knowing what to do. And then here's a couple examples of the butterfly and long condors. Now we're going to cover in this course this long condor, which is one that we do a super large amount of. Okay, so started this one back in 2019 as well. We've had 228 trades close out, 164 winners, 17 break even, 47 losers, 79% winning rate, unaudited. Now these are very low risk. Average maybe loss might be around $75 per spread. Returns of 2 to 1 up to 25 to 1, depending on the spread that we do. But the Condors is kind of the go-to one that we use so much. Here's one that I showed you earlier on Palantir. We're just kind of flip through this one. I showed you this one earlier. This turned out great. And then here's one more that we did on SPY. This was one that we did a long put Condor. So look at this one. This was one that we adjusted into the put Condor. So this one just really killed it as far as profit. But we started out with this one as a just a put debit spread, and we had $85 of risk. Now, when this fell off, see, we shorted it when it was at 568. And then it dropped down really hard here on the 11th, and now it's trading at 555. So we added a bull put credit spread and adjusted our risk down to just almost nothing. And then you can see our profits on the 11th of March now, just the next day after, just 1 day later, was this trade. Now, this trade was trading at 558, and we had adjusted this to the put Condor. We were up $205 per spread on our risk. I'll show you in a minute. Up 476% return. And then, towards the end of the day, it was trading here at 558. This trade was up 257, over 590% return. So this is hedging and doing stuff. This was just stuff you'll learn in the course, because this is what we want to look for. So we shorted it here. It ripped hard down here. We added the bull put credit spread. We locked in a huge credit, and then it went out right here, and we had a great profit. All right, so this is kind of that hedging that I was talking about earlier. So we were originally the 563, 560 put debit spread, and then when it crushed down, we added that bull put credit spread, the 550, 547.5. All right, so we knocked this risk down to $43 per spread. So we had the potential here, if it goes out in here, to make 257 on that, 597% return. Okay, so that would be the potential return there. And I've got to correct that other slide. It had the wrong return on it. But anyway, we ended up going out right there, pretty much right there smack in the middle. So we were up here, went from 43 bucks to 300. So we were up max profit 257%, or $257 or 597 return on capital. That's why these spreads are so great, because you get that capital at risk super, you can just really knock it down. When I say if, you might not still be in the trade. So right here, I always say if long, you may not be long, right? I could say long the adjusted, I just say if long, because you may not be in the trade. Is that, so question is, when you say if in your alert, does that mean if we take, yeah, that means if you took the trade. Yeah, and then question is the criteria to convert a counter diagonal to a condor when the stock is approaching resistance? No, there are a couple of different things I look at. They're not really. It's really we're looking at the short strike credit part of the spread. Anyway, there's a number of things that I look at, Carol. But come in the trading room or Q&A, and I'll kind of explain to you more on how that works if you like. All right, so this was a really great hedge setup that we did. And then just here a few more. These are very selective. These are what we call our lotto ticket butterfly. These are really fun and cool. Now these are very selective. We don't do a whole lot of these because it depends on the exact setup. But here's one we did, a SPY put butterfly pin trade, and this one just pretty much nailed it. This was one that you can see we set this up. SPY is trading at 573.80. And you can see here it goes out, it says new SPY pinning trade trading at 573.80. This is what we call a binary put butterfly. So it's either you win or you lose, but it's done because it's so cheap. So I said set this up the 10 March, 565, 60, 55. This will be a put butterfly at $40 or lower. Debit paid will be your risk, etc. And then you can see on the 10th, now it was trading down. Now it went from 573. Now it's trading down at 567. So this put butterfly now, I said, make sure to take some profit, watch it. So now it was going towards that 560 strike, which was a short strike. And then you can see at the end of the day, this was on the 10th. Now say the trade expires today. Make sure to take some profits, trading at 561. If long, the put butterfly, make sure to take profit today and close trade out prior to the close. Currently up $232 or 595% return based on the risk that we had on. So let's take a look at this. So we did this butterfly here, it was trading here. We were targeting this 560 area here. So here's the trade setup that we did. So we're targeting this 560. So we did this put butterfly 565, 560, 560, 555, put butterfly. Total risk on this trade into it at 39 cents or $39. Spread width, so $5 wide spread, 465, 60, 55. So potential, if we did get a pin up here at the top, to make $461, that would be over 1,183% return. All right, or if it goes out in here, it's still a fantastic return, but it's a lotto ticket because you're risking that debit pay, but it went out pretty close to a maximum pin. So it's actually 560.32 trading right there. So the spread went from 39 bucks to 456. So it was up $417 per spread, 1,069% return over that 4-day period. So that was an alert trade sent out specifically for that. And then this one was just incredible. This one was one of the best we had, well, best ever we did. So this was on Tesla, and it was traded at 189.35. We were looking for this one, a lot of pin trade, looking to target 200. All right, so this spread ended up going out up $231 per spread. It was up 1,925% return. And the reason is because of this. You'll see. It says new Tesla long binary monthly pinning trade, trading at 189.35, set for a potential monthly pin at 200 next Friday. Buy this butterfly, the 197.5, 200, 202.5 at around $12. Okay, so we set this up for $12. That's the risk. And then you can see on the 16th, now it was actually trading at 200 at that point of the day. It was up $215. That's a 1,791% return on that $12. At the end of the day, I said, wow, almost perfect pin. Actually, it was perfect. And it was trading at 207.07. The trade was up $230 per spread, 1,916%. Now we're, scaling out of this, but you try to save a little bit right for that, that pin. But anyway, this is what it looked like. So we set it up here. It was going out there right where we wanted it. So here was the trade setup. And this was just an amazing trade. So 197.5 call, targeting 200, 200, 202.5. Total risk, 12 cents, $12, $2.5 wide spread. Butterfly, we go out there, $238, over almost 2,000% return. And it did go out and pin exactly there, right there. Again, if you got multiple contracts, we're getting out, but you save a little, and at the bitter end, this thing was trading right there at $200 on expiration, max 238, 1,983. So it went from 12 to 250. So there was your profit there, just an amazing trade. All right, so that's pretty much everything. I hope this was something that helps everybody today. I look forward to seeing a bunch of you at the course, and here's the link again. Make sure to use that, and then sell 15 small cap. Pick out whichever you want, package 1 or 2, and if you do 2, you get everything in package 1 plus the alerts. Okay. Yeah, correct, John. Yeah, exactly, John. So you're going to buy. Let me back up so to show you the butterfly. So here's the put butterfly that you were talking about. Okay, so yeah, so the alert, it would say you're by the two, so it would say, I'll show you, it says 265. So when you see this come out, 265, 260, 560, I'm sorry, 555, okay? So what that means is it says buy, okay? So you're gonna buy the 265, the 565, 5, call, sell, 1, 560, it's a butterfly, and then you'll be selling another 560, and then you're buying the 555. Should have actually gone the other way. Okay, so that there it is. So basically, let me actually should have gone the other way with this. So basically, you're long the 565 put, short the 560, short the 560 again. So long the put, short a put, short the put, long the put. Okay, so that's your 565, short the 560 twice, and then you've got that risk cap by buying below it the 555. Okay, there's your put butterfly. Okay, yeah. All right, well, any other questions? So, and then I want to just point out a couple of trades you might want to be following this week with us when you come in. I'll show you. Well, you can't get it wrong if you do the puts. If you just follow it closely, just take your time. Here it says what to do. It says buy one butterfly. So you're buying, this is a put butterfly. So, we're looking for a downside move. So it says buy the 565, 560, 555. Okay, so you're buy your 565, 560, 560, 555. If it was a call, it would say buy the, 565, 570, 575, something like that. It was a call and it said buy the 565, 570, 575. It would be going the other way. 565, short the 570, short the 570, long the 575. Now I'm going to put together a cheat sheet though, so it'll make it easier for you to follow if you're not familiar. But these are exactly how it comes out with the Thinkorswim platform. Okay. All right. Well, again, thank you everybody for being here. And unless there are any other questions, we'll call it a day there and go from there. Now, a couple things you may want to be looking at next week. I'll just kind of throw them out there real quick. You might want to write these down. We'll be looking at these in the trade room. If you come in the trade room on Monday, a couple of trades I want to be looking at, potential trades that we're still looking at, potential for going long Dell. Now we're in Walmart, but it still looks pretty good. KRE looks potentially more upside. Another one that looks pretty good is Honeywell, HON. So you might want to take a look at a few of these, and we'll be looking at these in the trade room. The other one is CSX and Intuit, INTU. Okay, so just kind of wanted to tell everybody that potential trade setups for next week. Okay, so again, thanks so much.